Keeping our eyes on the markets, and they are trading off the lows of the day following a number of various Fed presidents speaking, as well as Janet Yellen, but probably one of the most dovish comments today came from Evans. Joining us now from Chicago is Todd Horwitz, Chief Strategist at BubbaTrading.com. Good to be with you, Todd. Thanks for joining us. And markets digesting more Fed speak. Specifically, it sounds like dovish comments from Fed President Evans really helping these markets out. What do you make of it?
Great to be with you, Catherine. You know, look, we're really just in one old big range here right now, and we are certainly Fed-driven, not economy-driven. Every comment that they make is whether we have a little bit of a sell-off or we have a rally. But if you look at the S&P, we're basically 2120 to 2190, and that's really the range we've been in for now months. And, you know, some of these bigger moves happen, but I think the biggest linchpin here is going to be what they decide to do with Deutsche Bank if they have problems with Deutsche Bank, because already the United States is trying to figure out a way to structure the debt that they owe them, the loan or the fine, and Merkel doesn't want to bail them out. If they let Deutsche Bank fail, that would be the linchpin that I think would bring the market lower, because we're at a ridiculous debt to GDP level right here. So there's no reason to think that the economy is going to get any better. So the only thing they can hope for is that the Fed keeps coming out with their dovish speak.
Yeah, hey Todd, it's interesting what you're saying about the Fed comments, because I mean, we saw Janet Yellen, but it was caged this morning by the Senate, whoever, so she wasn't really saying much. But it was about an hour or so ago that Charlie Evans came out, and that was some of the most dovish comments, almost like he was sort of coming on top of everybody, saying, listen, interest rates are going to stay low for a long, long time as a global phenomenon, and that seemed to be the last little pop in the market here. Do you get any sense that we're slowly burning out a little bit on the ability of these Fed governors to make the markets move higher? You know, Draghi's lost comments, what the Bank of Japan is doing lately with the yield curve, and they're getting less and less impact to actually economic growth and even now to the market moves.
You know, John, I agree with you 100%. I think they are starting to flame out, and I think what you're really starting to see is you're starting to see a creep up in the bonds, you know, and interest rates through the bond markets. And they can control, you know, the Fed, I personally believe the Fed is out of bullets. I don't think there's anything that they could possibly do anymore. I don't think they can print anymore. The debt is way too high, and they have a big problem here. And I think the bond markets are going to start squeezing these rates higher. And I think that will be the problem. And I think eventually we've already seen a big majority of the commercial traders out of the equity markets and actually short this market. And the markets are being more driven today by the retail traders who are borrowing money on margin to buy stock that they can't afford to buy. So I think that will eventually be your scenario. Where our patience is starting to wear thin with the Federal Reserve.
The other point you brought up, Todd, was interesting, is mentioning Deutsche Bank, because I think maybe that, you know, I don't know that I'd call it a Lehman moment kind of thing, but, you know, when you look at the derivative structure out there, what they have, are we underestimating the importance of what's going on in Germany with this major bank and where it's trading right now and what the risks are? That's, you know, the market seemed to skip over that one to a large degree.
No, I don't think we're overestimating at all. I think we should be more careful here, but this goes back to, John, when they made the decision in 2008 that it's too big to fail. Even though they're talking hard right now about Deutsche Bank, they're going to bail them out. I would bet on it. But at the end of the day, I think that problem is much bigger than anybody even wants to think about admitting. You know, a couple of weeks ago, people wanted to redeem their paper gold for real gold, and Deutsche Bank wouldn't redeem the gold. So now we've got the new problem that they owe the United States on a fine of $14 billion, and they can't pay it. There's a lot of problems that we choose to ignore, because the bottom line is the capital structure of banks is not what it's supposed to be. They never have enough on reserve that they're supposed to have, and eventually it causes a problem, and I think that's what we're starting to see right here.
I wonder as well, though, Todd, when we take a look at Deutsche Bank, maybe one of the reasons why the market seems to be ignoring it a little, well, definitely is, because we're climbing right now, and that's probably because of crude as well as Evans. So ignoring Deutsche Bank, but is the right takeaway perhaps not the fact that Germany is going to bail them out? I mean, is that the right conclusion?
Well, I think that you should, assume that, but they'll probably will. That's always the problem here. You know, you made this too big to fail bed for yourself, so it's hard to let them now fail. And again, the damage, the ripple effect that would cause around the globe would be traumatic. But of course, we were able to sustain the first time we had the news here, and the market's still stayed in this range, even though we had a little bit of a sell-off. But this whole debt structure, it's all going to come back down to debt, Catherine, and this whole debt structure is getting way out of control, and eventually the market won't be able to support the debt that it's making right now.
I just wonder, though, if Deutsche Bank today, and I used to work there during the financial crisis, I wonder today whether or not they are as large as they used to be in terms of all of the various products that they have, and they were massive in it. You know, from credit spreads, derivative products, mortgages, I mean, you name it. I mean, they were into everything. Massive.
I think they're probably bigger today.
You
this
think?
Is, you know, one of the problems when you bring, I do. I think one of the problems you bring in, if we go back in time just to 2008 when you worked there and you look at the reasons why they let Lehman Brothers fail and they let JP Morgan take over Bear Stearns, it was because they were over leveraged at 40-1. I would bet you say if we could get inside of that Deutsche Bank and see what they're doing, I guarantee you they're well over leveraged, maybe past that point. And that's where the biggest problem comes in, is that these products that they create, and then they create products on top of products, and even though we're not supposed to be doing them, we know that those things go on because it's part of the banking business.
We got to leave it there, Todd. Thanks so